Welcome to Video1C. In this video, we're going to calculate a whole bunch of different taxes. So you ought to get your calculator handy, and you probably ought to have your table pack handy as we work through this video. Okay, let's get started. To calculate a tax, you need to know two things. The first is the tax rate, and the second is the tax base. So the tax rate is the level of taxes imposed on a base. We usually think about that as a percentage, but it doesn't have to be. And the base defines what is actually being taxed and is usually expressed in monetary terms, but again, not always. So tax equals tax base times tax rate. Okay, so let's start with our friend SpongeBob. SpongeBob has taxable income of $75,000 in 2018. What is SpongeBob's U.S. federal income tax? So in order to solve this, we need to go to the income tax tables for 2018, which are in your table pack. And SpongeBob is a single guy, so we need to go find the single table and calculate his tax. So you can either do that now or you can work through this first one with me. Okay, so here's the single table for 2018. And what we need to do is identify where SpongeBob's income is. And at $75,000, he's between $38,700 and $82,500. So we take the $75,000 minus the $38,700. That gives us $36,300. We multiply that as indicated in the table by 22%. And then add to that the amount, 445,350. Now, if you're interested in what those dollar amounts represent, that's the tax that has accumulated up to $38,700. So if I take 10% up to $95,25 and then 12% of the money between $95,25 and $38,700, that total tax is $44,5350. So that's why I add 22% of the excess over that. I get $12,439.50. It's just that simple.
Learn it, know it, live it.
So Patrick, SpongeBob's friend, he has taxable income of $65,000. And he also earns $10,000 of interest on tax-exempt municipal bonds. So what is Patrick's income tax? Well, we follow the exact same pattern, except now, of course, he only makes $65,000 minus the $38,700 or $26,300. Notice we did not include the tax-exempt income because by default, that's tax-exempt. We do the 22%, add the $44,5350. We can find that Patrick's income tax is $10,239.50. So again, what's not shown in this calculation is there's a $10,000 worth of exempt income times a 0% rate. So of course the tax on that is 0 because anything times 0 is 0. So what are SpongeBob and Patrick's average tax rates? Well, we'll start with SpongeBob. We've calculated his tax like we did previously on the $75,000 of income. And to find someone's average tax rate, you simply take the amount of tax and divide it by their taxable income. So SpongeBob's average rate is 16.57%. So when you think about that, that's a function of the weighted average of first paying at 12%, then paying at whatever percent, and finally 22%. Patrick, here's the recalculation of his. We divide his by the $65,000 of taxable income. We can see his average tax rate is 15.75%. So average tax rate is a good way of capturing kind of what's the average tax you pay on every dollar you earn. And that's a better explanation than picking, for example, the tax bracket that they're in, right? It certainly wouldn't be fair to describe SpongeBob's tax as 22% because it's simply not 22%. So SpongeBob sees Patrick and he says, hey, I want a piece of that tax-exempt income. That 0% tax rate sounds like a pretty sweet gig. So he sells some of his taxable investments. And let's assume there's no taxable gain just to make things easy. And now his taxable income is $60,000, but he earns $10,000 in tax-exempt interest. So now what is SpongeBob's average tax rate? So if we look at new SpongeBob, now he only makes $60,000 of taxable income. We put it through the same meat grinder we have been. Multiply by 22%, the excess over 38.7. We get 913,950 divided by 60,000, or 15.23. If we happen to compare that to old SpongeBob, notice that he used to pay at 16.57%. So the question is SpongeBob better or worse off as a result? Well, if you looked at his average tax rate, you'd say, wow, SpongeBob is clearly better off, right? He's paying less average tax. So the question is SpongeBob better or worse off? So let's take a look at old SpongeBob. He made $75,000 of pre-tax income. He paid taxes of $12,000. He ended up with $62,560 in his pocket. New SpongeBob makes $60,000 plus the $10,000 of exempt. So, because even though that's not taxable, of course, it still puts $10,000 in his pocket. Minus the $9,000 of taxes is $60,000. So really, at the end of the day, the average tax rate isn't a good indicator of whether SpongeBob is better or worse off. It's after-tax cash flows that truly matter.
Learn it, know it, live it.
So we've introduced the concept of the after-tax cash flow, and we've also introduced this very simple equation. Pre-tax minus tax is after-tax. It's all so simple.
Learn it, know it, live it.
So how can we measure the slice of pie being taken from SpongeBob and Patrick? And we describe that as their effective tax rate. So the effective tax rate is the amount of tax divided by total income. So we can calculate that separate from the average tax rate, which was taxes divided by taxable income. Okay, so SpongeBob and Patrick are both looking at a possible investment that will generate $1 of additional taxable income. So if they generate that $1 of additional taxable income, how much better off will SpongeBob be? And same with Patrick. Okay, so let's pull up the tax table and look at old SpongeBob. Here's this same old calculation we're used to, right? The $75,000 minus the $38,700 times the 22% plus the dollar amount is about $12,000. So we need to do the same thing for SpongeBob with one more dollar. So now we take him up to $75,001 and we grind through the calculation and we see that his tax is $12,439.72. The difference is 22 cents. Now, if you think about that, we kind of could solve for that already. That would have been the $1 of additional income times the 22%, which is the tax bracket they're in. We call that the marginal tax rate. So that's the tax that you would pay for one additional dollar of income or perhaps one additional dollar of deduction. And you can see that that's just the bracket you're in. But what if the investment's going to provide an additional $100,000 of taxable income? All right, well, here's old SpongeBob. We certainly are getting used to this calculation by now. Here's new SpongeBob. He now makes $175,000. If you look at your table pack, you'll see that now he's into the next bracket. So his threshold is $157,500. We're going to multiply that excess by 32%. And we get SpongeBob's tax as $37,689.50. That is an increase of $25,250. But wait a second, that's not 22%. That's not 32%. That's 25.25%, right? That's the $25,250 divided by the additional $100,000 of income. That doesn't agree to the 32% rate in this bracket because SpongeBob is now suffering from bracket creep, which means that this increase in his income pushes him into a new bracket. And as a result, his marginal tax isn't as simple as just looking at the brackets. Instead, you have to recalculate his tax and divide it by the increase in income. So because the formula, the official formula for the marginal tax rate is the change in tax divided by the change in income. And it just so happens that in our $1 example, 22 cents divided by $1 is in fact 22% because we remain inside that tax bracket. Back to our original. So SpongeBob has taxable income of $75,000. Patrick has taxable income of $65,000 plus that $10,000 of tax exempt. And now we're going to assume that SpongeBob and Patrick are married. So what would their income tax be? So this case, we use a different table. We use the married filing jointly table. And taxable income is $140,000. So we just put it through the meat grinder, minus the $77,400 times 22%. And you'd see that that's $22,679. As it turns out, that is identical as if SpongeBob and Patrick were both single taxpayers. So what if instead SpongeBob and Patrick are married, but SpongeBob makes $1,000 and Patrick makes $139,000? So we're in a situation where one of the spouses makes substantially more than the other. So SpongeBob's tax would be $100. Patrick's tax would be about $27,600. So if they were to file this as singles, their total tax would be almost $28,000. But recall, for the same amount of income, if they're married, it's only $22,600. So there really is no marriage penalty anymore. This was a feature of the tax code for years and years, but with the latest round of tax reform, that's largely gone until income gets above $600,000. Okay, so just as a quick summary, marginal tax rate, that's the tax rate that applies to the next additional increment of a taxpayer's taxable income. And you can always calculate that as the change in tax over the change in taxable income. But for small changes in taxable income, it's whatever bracket you're in. The average tax rate is the taxpayer's tax divided by their taxable income. And the effective tax rate is the tax divided by total income. All right, now I want to talk about employment taxes for a little bit. And we're going to talk about employment taxes as an employee in this module. And then later on, we're going to talk about it as a self-employed individual. Okay, so employment taxes, as we know, that's the second largest group of taxes imposed federally. And it actually is two separate taxes. So FICA taxes, which is the other word for employment taxes, includes OASDI, which is the Social Security tax, and MHI, which is the Medicare tax. So OASDI is applied at 12.4%, and Medicare is applied at 2.9%. But Social Security is capped. And so what that means is there is a zero tax rate above whatever that year's threshold is. And in 2018, the threshold is $128,400. And that amount is adjusted for inflation each year. So in 2019, it will probably be a little bit higher. In 2017, it was a little bit lower. And typically, and certainly for the foreseeable future, these taxes are split between the employer and the employee. So the idea is half of it is withheld from the employee's paycheck, and the other half is paid by the employer. And there's also, under the Affordable Care Act, there's a 0.9% additional Medicare tax on higher income earners. And we'll talk about what those thresholds are in a second. Okay, so if we were to break this down into a table, here's what the employment tax table would look like. So Social Security tax, 6.2% for the employee, 6.2% for the employer, and that is taxed only up to the cap of what they call the FICA cap of $128,400 in 2018. Medicare is 1.45% for the employee up to $200,000. And then it's actually 2.35%. That's that additional 0.9 under Obamacare above $200,000. The employer is a flat 1.45%, irrespective of whether you're above or below the $200,000. And there is no cap on the Medicare portion. Okay. So we're gonna work here with Sandy. So in 2017, Sandy, single taxpayer, earned $145,000 of taxable wages as a gym manager. What is Sandy's 2018 FICA tax? So we're going to calculate her share and her employer's share separately. Then we're going to go on and calculate it as if it was $245,000. And then we'll also recalculate it as if it was 14,500. Okay, so the easiest way to do these calculations is out in Excel. So I would encourage you to take a break, push out into Excel, and follow along. Okay, here we go. Okay, welcome to Excel. So here we are. We've got the FICA cap entered and the wages that we're worried about entered. And notice that I've put the rates over here beside each one. Okay, so here we are in Social Security. And we know that the employee pays 0.62% times not the total wages. Because Sandy's income exceeds the FICA cap, it's only multiplied by the FICA cap. We can do the same thing for the employer's share. So that's the total amount anyone could pay in Social Security taxes in 2018. Now, when we do the same thing for Medicare, there is no cap on Medicare, so it's multiplied by her total wages of $145,000. And you can see that her average tax rate is 13.88% on $145,000 of wages. Okay, so our next scenario is Sandy's going to make $245,000. So if we're going to figure out her employer's share, well, we would take the 0.62 multiplied by 128.4, the 0.62 multiplied by 128.4. So because Sandy was already at the FICA cap, her making another $100,000 does not change her Social Security tax at all. Medicare, on the other hand, recall, is multiplied by the entire amount of wages. Plus, there's a kicker that the Obamacare additional 0.9% also needs to be considered. So we need to take this amount and add to it the excess over 200,000 times 0.9%. Gonna have to do a little fixing of the parentheses here. Just to make it clear, we'll put a set around this guy too. There we go. Whereas the employer's share is not affected by the additional Obamacare tax. So we just multiplied by the wages. Okay, and you can see that the average rate is now 9.56%. So the reality is employment taxes are regressive. As the tax base increases, the rate actually decreases. And that is because of the FICA cap. All right, now let's go back and look at Sandy if she only makes 14.5. So in this case, she is well below the FICA cap. So we simply multiplied by her wages. And same with her Medicare tax. And there's the 15.3%, right? That's the 12.4 plus the 2.9, or 15.3%. And again, speaks to the regressivity of employment taxes. Okay, we're done with Excel. Let's head back to PowerPoint. Okay, welcome back to PowerPoint. There's only one thing left to do.